Hello, everybody, and welcome to Confident Compounding with Corey Kramer. Today, we're going to be taking a look at Gartner stock, ticker IT. This one came in by request down in the comment section of one of my other videos. If you have a request, put it down in the comments. I'll get the ticker up on the chalkboard behind me, and eventually I will make a video. This one got bumped up the list a little bit because it had a big drop of nearly 30% yesterday. And it's also fallen a lot off of its highs. So usually when that happens, I get a bunch of questions anyway, and just makes them a little bit more interesting to talk about. So I do track this one in my spreadsheet, and I have done it for a while, but it's been pretty richly valued ever since I started watching it. As always, this is not individual investing advice, just how I analyze stocks. Okay, so Gartner, these guys do, I did just a brief looking into what they do. They're in the IT and consulting industry. It looks like about 80% of the revenues come from research-based things, whether it be like subscriptions or consulting and things like that. So right off the bat, I mean, I've seen a lot of these consulting businesses perform really poorly lately, and I do think that at least some portion of that has to do with AI and the question of how much or whether AI is going to be disrupting their business and their growth going forward. And then on the other end, the consultants for the government have potentially some like Doge cuts and things like that. So this whole industry has been selling off, and there's kind of two questions a person needs to ask. One, is this like a secular thing that really the market has it right? It's looking forward, it sees the danger, and this stock price adjustment is appropriate? Or is this, I guess there's maybe three outcomes, or it's just not happening, like the market's just overreacting too positively for some areas of the market, and this is one where it's reacting too negatively. Or it could be kind of a mixture of both, where much like a recession, you have the initial shock where earnings growth tips maybe to negative growth, which is what we're seeing here this year for these guys. But the companies adjust, the macro adjusts, and they, after a year or two or however many months, earnings start to grow again, and then they're back on like a growth trajectory. So you kind of are probably, before a person buys this, going to need an opinion on which one of those is the most likely, especially if you're planning on taking anything more than a small position. I usually take smaller position sizes because I don't usually do a ton of that type of work, because I don't think I'm any better than the market at it most of the time, unless there's like a history to go back and look at, especially at the macro level. I'm pretty good at that. But on kind of a sea change type of a thing, that's a little different, trying to predict what kind of effect AI will have. So I just want to kind of frame things that way before we get into this. So historically, let's get on the fast graph here. I mean, earnings have been, I'm not sure what happened in 2017. Maybe there was a acquisition or something where earnings kind of fell. So if we take that anomaly out, they've had, great earnings growth, steady earnings growth this whole time. Let's shorten this. We'll just see what the kind of quick long-term earnings growth is, like 17%. So that's extremely good. You can't really complain about that. And that partly explains the high PE ratio. Let's throw the normal one up here. See where we're at. So it's been averaging like a 32 PE, which is maybe appropriate for that level of growth rate during this time period. Although it might have got out of whack on this little. Let's see what it was. Well, that's not going to help. So the market's been valuing it pretty richly. When it gets up near these peaks, we're looking at high 30s PEs. And that's why I've never had a chance to buy it, essentially. Let's see what it was down here. Got down to a 20 in March 2020. So good growth so far, but we can see that maybe for the first time, once we exclude that year, that I can see, well, since the Great Recession, we have earnings growth declining. And when a high PE stock has earnings growth go negative, especially if it looks like it's going to happen more than 1 year, then this is what the market does. It sells the stock off. So this is down about 55%. I didn't quite get the high there, but it's down about 55% off of its high, which was just a few months ago, like less than a year ago. So definitely crashing. I'm sure there's some investors out there that are saying, okay, is now the time to buy. I actually got the request for it not too long ago, but it was before this big crash that we just had. So the way I'm going to treat this one is just to have a frame of reference. I don't think that, well, I mean, you can use like a basic PE if you want to, but we don't know where these earnings are going to bottom. So that could get worse this time, like next year, if earnings continue to fall. So even though I recognize that it's a different situation now than it was in 2008, that was a drawdown and a time when earnings growth did turn negative and when the market was generally pretty negative. Now, granted, it was a smaller company then. Right now, it's $18 billion company. But we do see a kind of similar pattern here. We have, during the peak, there it was a 40-something PE, but the last peak before it fell, mid-30s PE ratio going in. And then the next year, earnings fell 16%, which is kind of what we're on track for right now. And then eventually earnings picked back up. Now, again, this was a smaller company back then, so it's easier to do this. And once it did that, then the business did really well. So I'm not going to pick the exact bottom, but if you just kind of got the bottom there, you made 700% in a few 5 years or 6 years. So, and what was the PE up here? Back at the higher level growth PE. So this is one that if they start growing again off of a bottom, the person could do pretty well in it if it's a similar type of dynamic as back during the Great Recession. Again, hard to say whether that is what's going on. If it's not AI related and it's macro related, which it definitely could be because the economy is weakening, it could be much more like this situation, right? So back then, we can see how much it fell, which isn't going to be the main metric that I'm going to use here, but so it fell about 67%. Okay, so we're down 55%. It fell 67. So if you're going to try to use like a peak to trough, like I would use for like a deep cyclical business, 65% off the high would be kind of like the rough estimate, and it's not there yet. Okay. But I have a method that I use. I call it the recession PE metric. And what I do is I take the low price. So I think these are weekly lows maybe. But so it'd be $8.71. I take the peak earnings before the decline, which would be 98 cents back in 2008. And I create a PE out of that, which I call the recession PE. So to me, that's like the most negative kind of PE that you can come up with that doesn't reflect what the market's going to reflect, which is the current direction of the PE of the earnings. So the market will look forward. It will look at the direction earnings are heading. It will see where they are, and it will project down. And that's what sends the stock prices down so much during these little blips of earnings declines. Now, I do want to say their guidance was not 12.20, it was 11.75 for this year. So it's actually worse than what it looks like on the fast graph. Analysts haven't updated all their projections yet. So this is going to get down, it could end up down close to these 2023 levels. But what we do have now is we have an established peak of earnings, 1409. We pretty much know earnings are going to be lower than that. So, but the thing is, the market will keep getting negative and negative and negative the worse earnings get, even if in a couple years they recover, right? So the market won't reflect that until it kind of sees some kind of light at the end of the tunnel. But if you use this as your marker, like I did back at creating the recession PE, these peak earnings don't change. And that can help you kind of keep a steady hand or have like a baseline to kind of look at when things are really negative, so you're not extrapolating out the negative like the market is. Built into this is an assumption that in a few years, the earnings will pick up again, maybe similar to what they did back. Actually, they don't even have to be similar to what they did in 2008, just that the bottom is going to kind of come in a similar way as it did in 2008 and 9. And then the recovery is just a question of how long it takes and whether it happens and all that. But typically, if you buy these low enough, back hit like Great Recession levels, you're usually giving yourself a margin of safety that the people that were buying the stock back here, hey, you made a couple bucks if you pick the bottom back in 2022. So it could definitely still have farther to go. So the way I calculate that is I have a little spreadsheet set up. So let me move my head here so we can see the titles. So what I want here is the adjusted recession bottom price to peak EPS. So recession PE basically. When you do the math on that, it's 8.89. That's the PE. Now, I can adjust this manually going forward, but since this is so pessimistic and since that PE is really low on just an absolute basis, at like less than 9, which is like a third or something of what the S&P 500 PE is now, I add 40% to it. So when I do that, it creates a recession PE with kind of, I call it a buffer, because I'm not trying to pick the bottom in these. What I'm trying to do is not buy them too soon. Like imagine the people who bought the stock a couple days ago. Like it was down quite a bit. It had previously been good. They bought the stock and then, the next week they're down like 30%. So this is to try to help not buy a stock too soon during one of these downturns. Now, it's not foolproof. You can definitely buy these after the recession buy price hits, and they can still perform poorly. But usually it will help you miss the giant declines, like the just soul-crushing declines. Especially if you're paying attention and before you buy it, you really kind of assess, know the risk, look in deeper into the business, which I haven't really done yet. But this gives you some ballpark framework, so you're not just kind of stabbing in the dark. You have a reference in the past to look at least say, look, this is possible. A lot of times the market will even go back, I think, and behave similarly as it behaved in the past, whether it's justified or not. So there's still judgment that needs to be made, but this is the recession PE number. And so if you want a dollar amount, like a price that will hit that, it's about $175 a share, which is about 28% lower still than where it is right now. So that's what I'm looking at for this one at this particular point in time. And, if I would have made this video, I don't know, 6 months ago or something like that, it would have had basically the same number because it's based on the peak earnings. So once, see if my fast graph comes back in. There we go. So once earnings started to fall this year, and it looked like that was going to happen, and we had these peak earnings in, basically once 2025 earnings were lower than 2024, that buy price would have been established at 175. So, which maybe, let's say you could have known that or saw that or whatever. I don't remember exactly when the analyst estimates started falling, but back in May, which is just a couple months ago, well, that would have saved you, it's not pulling up my declining, but it would have saved you like 30 or 40% decline in the stock. Now, sometimes, and I make a lot of these videos, okay, so every now and then somebody will comment on an old one where this stock does bottom here and start to come back. And that definitely happens. But I like to have some kind of method, some kind of reference point that creates that method, because I think the odds of somebody bottom picking here, from most of the methods I see people use, are about the same as the odds of somebody buying it, a week ago and thinking it was the bottom. So some people will be right on the bottom, and there are going to be stocks that come down, fall here, bottom here, and then start to grow again that I won't end up buying. But I watch over 700 stocks now, so I don't need to get every single one. And then there's a question of how sustainable is the bounce that a stock might have. I don't need to get every single one of those. And if you get the ones that are really cheap that come back, you make a lot more money than if you buy up here and then have to get through the downturn and then you come back and maybe you can do okay. But the deeper you buy them, the more money you make and the less you lose when you're wrong. So as long as you can monitor enough stocks, which is what I'm set up to do in the Cyclical Investors Club and on the Confident Compounding Patreon site, which I have weekly picks over there for $25 a month. There's a free tier over there too, where I post all the YouTube videos plus more. And then I have a full service where you can go to the spreadsheet that I was just in and see what the buy prices are for everything and see how they're calculated and all that stuff. So I watch a lot of stocks so that I don't let really obvious ones slip by. Like I don't miss them. And there's trade-offs to all this. But I also don't do a ton of deep research on individual businesses most of the time because it takes too much time. And if I'm doing that and I require doing that before I buy something, they can come down and bounce off those low prices and I can just totally miss them. It's very rare that I totally miss like a pretty obvious opportunity because I follow so many stocks. And I've already weeded out the ones that I would like to buy for the most part. So it's okay if the harder ones, there's always going to be some that bottom tick and there's going to be some which you make a lot of money on if they're successful. And then there's going to be some that almost get there that you don't end up buying. That's an opportunity cost to some degree if you don't get enough of your money in the market. But usually I do. You can go back and look in April. You bought a bunch of stuff. If you go back to March 2020, I bought 30 stocks that month. So I can act quickly when a stock hits the really good value or growth or reasonable price metrics that I think are good. Okay, so that's my thoughts on Gartner. $175 is where I would consider start buying. I probably nibble at it just then and then kind of just take a pause and see what the AI picture is maybe going to be. So, and you kind of saw me do that with healthcare stocks. They got hammered, bought a little bit, keep watching. Things seem to be getting worse. So you can just pause and wait and kind of see what happens then before you add and really start building positions, like a bigger position. So this might be a situation where it's going to be similar. And we'll just have to wait and see. But start with a low price, just kind of helps everything. All right, if you found this useful, hit the like and subscribe button. Check out the free tier over on Patreon, and I'll see everybody later.